Money in, money out. That's the heartbeat of every business. Whether you're a freelance artist, a coffee shop owner, or an online retailer, understanding this flow is the key to not just surviving, but thriving. But how do you keep track of it all without getting lost in a sea of numbers? That's what we're going to break down today. I'm going to show you the simple, no headache way to record your financial transactions so you can finally feel in control of your business finances. Let's start with the absolute basics. There are three main types of transactions you need to know about: income, expenses, and assets. Think of them as the three main characters in your financial story. First up, income. This is the fun part. Income is any money that flows into your business. The most common example is sales. When a customer buys your product or pays for your service, that's income. Let's say you sell a handmade candle for $20. When that cash hits your account, you've just generated income. It could also be interest earned on your business bank account or a refund you receive from a supplier. Anything that adds to your business's cash pile is income. Easy, right? Next, we have expenses. These are the costs of doing business, the money flowing out to keep things running. Think about your monthly bills, like rent for your studio or your website hosting fee. What about the raw materials you buy? The clay for your pottery, the coffee beans for the fabric for your designs, all expenses. Even marketing costs, like running social media ads or paying for software subscriptions, fall under this category. Expenses are the investments you make to generate your income. Finally, let's talk about assets. This one can sound a bit more complex, but it's straightforward. An asset is something valuable that your business owns and will use for a longer period, typically more than a year. It's not something you use up quickly like office supplies. A classic example is a major piece of equipment. If you're a photographer, your professional camera is an asset. If you run a delivery service, the company van is an asset. Even the laptop you use for all your business operations is an asset. These are long-term investments that help your business operate and grow over time. So income is money in, expenses are money out for day-to-day operations, and assets are long-term valuable items you own. Now you might have heard the scary words, debit and credit. Let's demystify them right now. Forget everything you think you know from your bank statement. In accounting, debit and credit are just directions. Think of it like a two-lane street. Debit simply means left and credit simply means right. Every single transaction has two parts, a debit and a credit. It's called double entry bookkeeping, and it ensures your financial records are always balanced. Let's use a simple example. You sell a product for $50 cash. The cash in your business has increased, right? An increase in an asset like cash is recorded on the left side as a debit. So you debit your cash account for $50. At the same time, you've earned income. An increase in income is recorded on the right side as a credit. So you'd credit your sales income account for $50. See? Debit $50, credit $50. The equation is balanced. Let's try an expense. You pay your $100 internet bill with cash. Your cash goes down. A decrease in an asset like cash is recorded on the right side as a credit. So you credit your cash account for $100. Simultaneously, your internet expense has increased. An increase in an expense is recorded on the left side as a debit. So you debit your utilities expense account for $100. Again, debit $100, credit $100. It always balances. Don't worry if this feels tricky at first. The key takeaway is that for every transaction, you're just noting what you got and what you gave up, using these left and right columns to keep track. So how do you actually record all of this? You can use simple spreadsheet software or dedicated accounting software. The tool isn't as important as the habit. I've created a free downloadable sample journal template to get you started. The link is right there in the description below. It has columns for the date, a description of the transaction, the accounts affected, and of course the debit and credit amounts. Let's walk through filling it out. Imagine on Monday you made a sale of $200. You'd enter the date in the description. You'd write something like daily sales. You would debit your cash account for $200 and credit your sales income account for $200. Then on Tuesday, you bought $50 worth of supplies. You'd enter that date, description, purchase of raw materials. You debit your supplies expense account for $50, and if you paid with cash, you decredit your cash account for $50. You ray just telling the story of your money, one line at a time. Why is this so important? Why should you record these transactions daily? Three big reasons: clarity, confidence, and control. First, clarity. When you record things daily, you have a crystal clear picture of your business's financial health at any moment. No more guessing if you can afford that new piece of equipment. You'll know. Second, confidence. Tax time is no longer a nightmare where you spend weeks digging through a showbox of crumpled receipts. Imagine having everything neatly organized, ready to go. That's a huge weight off your shoulders. This financial clarity gives you the confidence to make smarter business decisions. Should you raise your prices? Can you afford to hire help? Your records will hold the answers. And finally, control. Recording your transactions daily gives you ultimate control over your business. You can spot trends early. Are your material costs creeping up? Is one product selling way better than another? This data is pure gold. It allows you to be proactive, not reactive. Daily recording equals peace of mind. It's a small 5-minute habit that transforms you from just a business owner into a savvy financial operator of your own enterprise. Let's recap what we've covered. The heartbeat of your business is the flow of money in and money out. We track this through transactions, which fall into three main categories: income, which is money coming in; expenses, which are the daily costs of running your business; and assets, which are the long-term valuable things you own. We learned that debit and credit are just accounting terms for left and right, used to keep your books balanced for every transaction. Most importantly, we learned that the habit of recording these transactions daily is what gives you clarity, confidence, and control over your financial destiny. It's not about becoming a certified accountant overnight. It's about building a simple, powerful habit that will serve you for the entire life of your business. Start today. Don't wait until the end of the month. Take 5 minutes after you close up shop to log your sales and expenses for the day. It will feel a little strange at first, but I promise in a week it will become second nature. And in a month you'll wonder how you ever ran your business without it. Don't forget to download the free sample journal template in the description below to get a head start. It's a simple tool, but it's the first step toward true financial mastery. If you found this video helpful, please give it a thumbs up. It really helps the channel grow. And for more simple, practical business advice, make sure to hit that subscribe button and turn on notifications. Thanks for watching, and I'll see you in the next video.